presenting on the office REIT sector today. So let's move right on to the investment thesis. So this oversupply of Class A office space, which is represented in our portfolio by Boston Properties, threatens rental rate growth and overall demand for existing properties. A shift towards scarce and more desirable life science office space will help to counter this. Hence, I propose we buy Alexandria Real Estate Equities and sell Boston Properties. So let's just kind of break this down. If you're unfamiliar with the current office environment, look no further than New York City right now. You see sort of every month it looks like a new building's going up. And that's really represented by the negative net absorption metric. And that measures the absorption of new properties by tenants. So while we see leasing going up in New York City, we see properties coming online at a faster rate. And if you remember your economics courses, what that leads to is decreased rental rates, which is a major threat. And I bring up New York City because New York City accounts for 40% of Boston Properties revenue. So if we see hits to the rental rate growth at Boston Properties, it's going to really affect our portfolio, our Boston Properties, and it has a real impact on this fund. All right, so let's just move on. Summary scores, we see Alexandria is strong across the board. Boston Properties, not bad on the balance sheet and the management, but definitely has issues with the price, the valuation, and the business. So just to break down these two companies, I'm going to do a side-by-side review comparison. The main difference is that you have Class A office with Boston Properties, so think of your typical, your high-value office space, and then Alexandria's life science office space. And another word for life science office space is just labs. So that's basically science labs, is what you can think of. The green on the map are going to be their biggest markets where they get 20 to 30% of their revenue. So for Alexandria, we're looking at San Francisco, San Diego, and Boston. And for Boston Properties, we're going to be looking at Boston, DC, and San Francisco. Similar prices, both trading at a discount to NAV, which is expected, the office REIT sector generally trading at a discount now. 52-week range, similar in terms of their movement over the past year. Boston Properties is a little bit higher on the end of that 52-week range, but if history is any indication, they won't be moving anywhere above that. Market cap, we see 24 office REITs with $101 billion or so in a market cap total. So these are big players. Boston Properties is the largest office REIT, and Alexandria is the third largest. So both big. Dividend yield, good for Alexandria, slightly below the industry average for Boston Properties. Interest coverage ratio, again, above the industry average, Alexandria, below for Boston Properties. And fairly healthy price to FFOs. Just to break down their capital structure, you see here just from a distance, Boston Properties, much more reliant on debt. Alexandria, much more reliant on equity, represented by their debt to equity ratios, EV to EBITDA. Both do have the same credit rating on their debt by Moody's, which is solid, a good rating. But we do see here that Boston Properties is a little more leveraged, and to me that presents a little bit of a risk. Looking at their management, we can see here their compensation schedules kind of broken down. Proportionally, Boston Properties a little bit more cash-based than performance-based, which I docked one point. And then the second point I docked is on their management sort of history and how they're going about managing the company. Alexandria really focusing on diverse sources of capital, on laddering debt maturities, on equity issuance now, and on managing its debt, whereas Boston Properties focusing more on leveraging its buildings and issuing debt instead, so which presents potential risk if it continues to move in the direction of high leverage. Valuation, real quick here, we have discounted cash flow, NAV, dividend yield, and price to AFFO. For the discounted cash flow, I did use AFFO, and then I did a multiple and a perpetuity for the terminal growth, and then I kind of discounted the perpetuity, and they came out about similar. Kind of all over the place here, really, and I'm going to kind of lead into the business and why that is in the next slide. But you can see that they're both undervalued, more or less, but Alexandria definitely by more metrics than Boston Properties. All right, this is the main sort of indicator that should catch your attention. We have Alexandria. We have in the blue, we have the revenue growth, and in the pumpkin color, we have the AFFO growth. And you can see that historically for the industry, the average revenue growth is about 5%. And you can see here Boston Properties first year about 12%, and then it kind of stabilizes at sort of 2% below industry average, whereas Alexandria really taking movements, really big strides, 16% the first year, and the 20% all the way up, and the FFO follows that. One of my favorite measurements is this: 10K invested 5 years ago, kind of show you how much growth potential there is and how much there has been. We've more than doubled with Alexandria, but we'll have only gained about 50% with Boston Properties. I'll give you an idea of the number of properties as well. And the major metric here is the occupancy. And I don't want you to look at that and see it as, as affecting their revenue per se, but just to give you an idea of the demand for what they offer. 97.3% is exceptionally high. Their 10-year average is 96%. And Boston Properties, 91.1%, below the industry average of 93%. And here we have, historical strong demand for the asset that Alexandria has, which is labs. So, it begs the question, how will Alexandria continue to grow their revenue? Is this just sort of a thing in the past 5 years, or is it going to continue? And the answer is, it will continue. And how? Through the continued development of life science campuses. And this is East Cambridge, actually my hometown. But Greater Boston accounts for 40% of Alexandria's revenue. So I thought it was an apt example. You can see the concentration of buildings. This is right in Kendall Square, so you have MIT here, colleges here. It's a biotech hub, really. And you see them developing these new areas. And then you see here, will it continue to grow? And the answer is yes. 2018 and 2019 deliveries account for over 3 million rentable square feet, which is about 10% of their current portfolio. So we have 10% more labs coming online in the next 2 years, 95% of which is already leased or being negotiated, which is incredible. It's about 86% already leased, and then the remainder being negotiated. So there is incredibly high demand. On a cash basis, you're seeing, same-store net operating income increase by about 5% a year, which is insane. People are leasing up early, they're releasing early, and you're seeing real rent escalations there as well because the demand is so high, which is kind of the opposite of what you see in the office, the traditional Class A office. And then moving right along, just to break down their tenant base, Boston Properties, similarly strong tenant base, but again, it's Class A, so I wanted to focus more on Alexandria. These are the top 20 tenants. They account for 50% of their revenue, and nearly 80% are investment grade. You can see here broken down by sector, pharmaceutical, public biotech. The main thing that sort of catches my eye as a risk is the public biotech, or the private biotech, that 9% chunk. There's kind of potential risk there of how is that funded, and the answer is, through venture funding, which is, perhaps likely to change, but we look historically over the past year and we see that quarter over quarter venture capital funding in life sciences has increased. So even those smaller firms that are renting out space are able to continue doing it moving forward. And again, we have occupancy at 97%. Some campuses have 100% occupancy, very high rates. And 97% are triple net, and then 94% contain annual escalations. So overall, we have a very strong tenant base. And just to conclude, again, with the oversupply of Class A office, it's a real threat, especially in the major market that Boston Properties operates, New York City, 40% of the revenue. And then, I'm proposing a shift to Alexandria, which is labs, where we see continued strong demand, which will continue into the future. And I propose we buy that and sell Boston Properties.
Well, we're done. Questions? Mr. Abrams, thank you. What about this occupancy rate? How does Alexandria keep it so high? It is quite high. What's the story behind that?
So people typically think of Class A office space as high barriers to entry, especially in New York City. But the answer is, while it is high barriers to entry, it's not as high as labs. Labs require a bit of investment. They're highly specialized, and so they are, again, higher barriers to entry than even Class A. And right now, there's not enough supply for those labs. Alexandria, if you look around, no other REIT has this concentration of labs. I mean, there's really no competition at this level for Alexandria in the lab area. So they have this sort of under control and are controlling that. So that's how their occupancy is so high.
And has management talked about the growth? You also mentioned on the same slide the number of the property.
Yeah.
Has management discussed, what's the growth look like? Obviously, the chart that you showed demonstrates good growth. Are they expanding the number of properties? Are they filling out the existing properties with more space? What's the goal?
Yeah, absolutely. The goal is developing new campuses, but also in those campuses creating new labs, new buildings. So the growth in terms of properties, I think on both fronts you're really going to see increases. Although now with cap rates so low for the office, we do see both of them, both Boston Properties and Alexandria, selling and kind of cashing in on these low cap rates, and then using that to fund both redevelopment and new acquisitions.
Can you go to the geographic slide, the map? Yeah, that one. So, what are which are which? The green dots are the primary locations?
Yeah, the green dots are the main ones, and which just means that I think, for example, Greater Boston with Alexandria is 40%. On the Boston property side, the green, again, New York City, 40%. Boston, about 35%.
Okay.
And then over here, San Francisco and San Diego, similarly high accountability for revenue.
And the other ones are what?
The others are markets where they exist, but where they're only maybe 10% of their revenue comes from.
And are they, so for Alexandria in particular here, are they planning to expand further into those markets that are maybe this, not as significant for them yet? Or are they planning to expand to their existing? Or what's the geographic growth plan?
Sure. Absolutely. I think it's really all of those. It's building new campuses where they can succeed and flourish, and it's adding to their current ones. If you look at the map slide, I didn't focus too much on it, but if you look at the key here, you can see that undergoing construction in their already strong campus. They do have new buildings being constructed, and I don't know if there's near-term projects, but there are intermediate projects as well. I know the Binney Street locations have been there for a while, so they are continuing to add, continuing to improve and develop within their current campuses, and then also expand and bridge out.
Any other questions? If not, clap it up. Thank you, Mr. Abrams. All right, so take